Good afternoon, everyone. This is Rich Swerbinski with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly whirlwind through all the latest happenings in the mortgage industry. Each week, I am pleased to be joined by one of our lender members as my co-host. And this week, very happy to be joined by longtime friend, former boss, the EVP of Mortgage Banking for First Commonwealth Bank, Stan Foraker. Stan, good to see you.
Good to see you, Rich. Thanks for having me. Happy National Homeownership Month.
National Homeownership Month, yes. And we'll get more into home ownership trends. And Stan, also a fellow Clevelander and former boss of mine. I remember, there you go Browns. All right. Being a young punk secondary guy at Home Savings and Loan out of Youngstown, Ohio. And they brought in this very accomplished head of the division from Fifth Third. He was a little terrified at the beginning, but Stan and I ended up forging a great relationship and have maintained that relationship. And then when I took this job 6 years ago, he was one of the people I kind of called, like, please join TMC. And he took a chance on us and one of our earliest members, and wanted to start by thanking you for that, Stan.
Yeah, thanks, Rich. I'm proud of you. You've done well. You were the smartest kid in the class, so I'm really proud of what you've accomplished. Congratulations.
Thank you. And so let's go ahead and get into it here. And I should note, I'm broadcasting live from St. Louis, Missouri. Actually, behind me is the headquarters of Capacity, great partners at TMC. They provide AI-powered solutions for our lender members, one of our preferred partners. We've got about half our team that's out here for kind of like a day and a half meeting. They're building some chat bot and other cool functionality for our members that will be available on our website, ultimately on a mobile app. So I wanted to give a shout out to our friends and partners at Capacity and for having us out here today and allowing me to use their cool techie looking space to record this week's episode. So, but Stan, let's get right into it. Let's start with the pending Supreme Court case that we could have a decision rendered really any time now regarding the FHFA, really addressing two things. One, the structure of FHFA, and if it's constitutionally structured, the ruling could allow the Biden administration to fire the current director, Mark Calabria. That would make a lot in the industry happy. And then the other piece of it too is it constitutional the way that Treasury is just sweeping all the profits from Fannie and Freddie each month, which have been exorbitant as of late. And I always tell people if you want to learn more about this underbelly of people that were originally Fannie and Freddie investors, go on Reddit. There's a subreddit, Google Fannie Freddie. You'll see there's this Reddit of just angry Fannie Freddie stockholders that have been waiting for this decision for years. So with that preamble, I'll start. Any thoughts on the pending case? What may happen? What's likely to happen? Any thoughts on the pending Supreme Court case?
Yeah, Rich, I think there's a pretty fair amount of sentiment that the court will sustain last year's ruling around the unconstitutional nature of their authority and their structure. But we have seen in some recent court rulings, contrary to maybe some media hysteria, that you really can't assume partisanship with this court. So I think it's safe to say that while Mr. Calabria has his supporters, there also exists a pretty bipartisan angst about some of his directives from all parts of the mortgage industry. And if the court does go against sort of the sentiment and rules in favor of the Biden administration and they exit Mr. Calabria, I'm not certain there's going to be a lot of tears in corporate hallways in the mortgage industry right now. So, but I think, frankly, while that'll get a lot of attention and a lot of headlines, I do think the latter issue, the sweeping of the dividends, the sweeping of the profits, that so-called net worth sweep is really critical, really important, because it's going to really go back to this whole discussion around the privatization of the enterprises. And I think, we've all been talking about it, thinking about it, wrestling with what that might look like for I don't even know how many years now. But I think that can really, that impact on capital or future capital infusion really can change the course of where the enterprises go. So I think if the court rules in favor of the Biden administration, I think may even be a more significant outcome.
Could have huge impact on our industry, to be sure. And yeah, it's a lot of people waiting to see what happens there. Moving on to the interest rate climate, interest rates have dropped back down. 30-year fixed rates are back in the high twos. Or some job data has not been great as of late. Some of the inflationary fears that were pushing Treasury and mortgage bond rates up have subsided. So rates in the low twos, how has that impacted volume as of late? And is this the end of the party with the economy seemingly, on the pickup here? With that, could that take rates up with it into the threes? And how do you look at that as a business owner?
Yeah, I think there's a lot of moving parts now, and the May jobs report was probably a little better than we thought it was going to be, but not as good as maybe the Fed thought it might be. That might have driven earlier tapering. So we've got that coupled with the consumer price data coming out this Thursday, the 30-year bond auctions. I gotta say, Rich, I think rates are going to be bumpy. Yes. I don't think we're going to see a catastrophic change or even significantly precipitous change in the near term. I do think, across the back fence with my neighbors in the backyard cookouts, I'm kind of talking about the fact that while I think I'll see some slightly lumpy and upward movement over the next 12 to 18 months, I don't think it's going to impact affordability, not dramatically anyhow, barring a major catastrophe that we haven't thought of, right? Or that we didn't anticipate, like, I don't know, COVID, for instance, something like that. But, we're coming out of the worst Treasury market in 40 years in the first quarter. I mean, so, and even then, the shift isn't impacting affordability to the extent that it's stopped the market. So when I talk about a catastrophic stop, I'm talking about something that falls right off the cliff that reminds us of 2007, 2008. So long ago, when I first got trained into business, I was taught not to predict rates. I still don't predict them, but if I had to guess, I see sort of a long, lumpy, minor decline, and maybe yields on the 10-year are 15 to 25 basis points higher than they are now in the next 18 months.
I think it's been like
I don't know
20 years in a row now that economists are predicting 30-year fixed rates to slowly go up, into the high threes. It doesn't seem to ever happen, but we'll see what happens this year. And
we're kind of holding steady right now. I mean,
have a surprise. The TMC team making a guest appearance is our member engagement team, and Tom Gallucci, Tom and Faith Howard Mooney, Ashley Alexander, Angie Scarfina, Sarah Oldani Wood, Ryan Carr, our newest addition to our member engagement team, all saying hi from the Capacity headquarters in St. Louis. So,
hello. Hey, Dan. Hi, Dan.
Okay. Again.
So thank you guys. So moving on, and I, tend to agree with you. I think I don't think we're going to see anything, just because I think the Fed's going to remain a very active and willing buyer of mortgage bonds enough to make it where we don't get kind of runaway mortgage rates. But leads into the next topic I wanted to hit on, which is just in general, consumers' perception of the home buying conditions right now. We've seen Fannie Mae just came out with a study that they do monthly that kind of weighs home buyer sentiment. It was as low as it's been in a long time. If I remember correctly, only 35% of people saying right now is a good time to buy a house.
Right.
We've seen other studies that have really expressed very legitimate concerns that, I think one thing we've seen recently is people that own a home that maybe want to buy a bigger home are really concerned about doing that right now. Because the more expensive home you buy, the risk of buying a home at the quote unquote top end of the market becomes greater. So just want to get your thoughts on what you're hearing and seeing and feeling out in the marketplace from your customers on just home buyer sentiment in general right now as we head into the hardest spring and summer.
Yeah, that study you quoted at 35% believe it's a good time to buy. That same study says 56% of the people polled think it's a bad time to buy. And that's the first time in maybe the last 10 years or so that it's been more majority of people think it's a bad time to buy. And that's happened very quickly. This has been as a almost 38-year veteran, this has been fascinating to watch, Rich, because we get this superheated housing environment where everybody's paying a premium for every decent house out there. And as that accelerated over the last couple of years, then consumers said, okay, I can't buy existing house, at least for a price that I think is reasonable or that I'm able to afford. So I'll go and build. And so it was almost a tidal wave of buy existing housing, it gets superheated, and then the shift goes to construction. Except that, surprise, lumber costs go up 383%. I just was on a MBA call earlier today where they're in cooperation with National Association of Home Builders, and they were quoting all of the material cost increases. Lumber was number one. One of the big ones was appliances. You can't get an appliance. And my wife and I just tried to buy a new dishwasher. We went to Lowe's and they laughed at us because they said, we can't get one. So watching this shift of consumer sentiment from existing housing, superheated, probably overpriced now. People are probably paying too much for houses now. We can see this in the appraisal side, which we may get to here in a minute. And then they move to construction. And now the thing we're seeing is, besides the increase in costs, builders are elongating the construction terms. So a house that was 6 months to build before, builders are starting to say it's going to be 9. And if it was 9, it's going to be 12, and so on and so forth. So you've got inflated costs. You've got builders now coming to the consumers who already have an executed contract and saying, sorry, we need 20% more just because of these unintended consequences of these material and lumber costs. And it's creating this tsunami, if you will, of at some point this has to stop, right? At some point something has to give. Again, I don't know what the crescendo leads to, but there is a crescendo building in my mind where it moves from existing to new construction. And we'll kind of see where it goes from there. But that, I don't think it's the precipitous drop off like we had in 07, 08, but I do think something's got to give at some point. So consumer sentiment is a problem. It also shows up now in it shows up in some other areas. I guess we'll probably get to it, but appraisals are a big problem. That came up in this call today too. The Builders Association, the National Association of Home Builders, is really trying to work with lenders on appraisals, but in a market and an industry where comparable sales really drive appraisals, costs to build, income, those are factors that need to be a part of it. So the other thing we're seeing in the construction space is more and more build contracts are cost plus. So you've agreed to build the house, but if there are additional cost overruns or additional cost demands, then you as the consumer agree to pay for that. So that's not the first time in the history of construction lending that cost plus contracts have existed, but they sort of fell out of favor. This is a generalization. Recently, not so much. Now they're starting to come back with a vengeance. So consumer sentiment, the consumer doesn't know where to go now and what to do, because there really is no outlet for that pent-up demand.
Thought that was just a really excellent overview of really kind of like the recent history of consumer sentiment, exploding interest in existing homes, and then screw that, they're going up. I want to build one. Oh no, wait, I can't. It costs too much. And now it's kind of like, musical chairs, and the music's ended, and it's like, oh, okay, now what do I do now if I want to buy a house? There's nothing but bad options right now. Of course, I just bought a house, maybe at the worst time in the history of the Fannie Mae Sentiment Index to do so. Forgetting that, First Commonwealth Bank has always been such an active and committed player in lending to low to moderate income borrowers. You guys have been heavily engaged in our community first working group, leading sessions at conference in and around low to moderate income lending. All of these dynamics you just spoke of, homes not being built, not enough homes being built the last 4 or 5 years, home values going up, current construction really being challenged and elongated, for providing no help at all to the inventory and escalating prices issue. What does this mean to low to moderate income borrowers? Evan, that runs that group for, like, what he's, I've been on some calls with him. I mean, he's stressed out about this. How do you look at that as a bank that is very active in that low to moderate space?
Yeah, this market has sort of resulted in some unintended consequences for the first-time home buyers and the LMI borrowers. For instance, the real estate community, the realtor community, is starting to be wary of FHA applications or FHA purchase offers, simply because we have so many times when it has to be an overlist offer, or if the appraisal comes in short, the borrower has to make up the difference. And if you'll excuse the generalization, generally speaking, an FHA borrower is a minimum down payment person with not lots of extra reserves. So the realtor community is wary of those offers. And so that's making what is already limited housing options to the first-time homebuyer community and LMI community even more scarce. It's a real conundrum. And this is taking place at exactly the same time that that there's a groundswell of support to help with affordable housing. So not just out of the Biden administration. You've heard Sherrod Brown probably talk about, hi, Jim.
Hey,
You've
Jim,
heard.
one second, hold that thought, because you're on a very important topic. Our CEO, Jim Park. Jim, say hi to the Last Week in Mortgage Today
Hey guys,
audience.
how are you?
Hi, Jim.
I'm not a new employee at Capacity. We're just happen to be here.
He left San Diego for this meeting, so it's an important one.
Yeah, good seeing you guys.
Hi, Jim.
Good luck with the rest of the call.
Thank you. I'm sorry.
So Senator Sherrod Brown, chairman of the Senate Banking and Finance Committee, is really made housing, and affordable housing particularly, a centerpiece of some of his efforts in his new role this year. So, there's some really positive things happening, but there's sort of this loggerheads between things like the market impact of, again, FHA offers as an example, and yet efforts by many organizations to increase affordable housing opportunities. I think MBA's done some nice work. For those of you that are familiar, and maybe if you're not, they have two programs called Convergence, one in Memphis and one in Columbus, Ohio, one of my markets, where it's a really good example of concentrated efforts to get multiple shareholders and stakeholders working together on affordable housing issues. But it's a big deal. And I really am happy to see so many partners, really, Rich, starting to come together on this, but we don't have it solved yet. We've got a housing shortage, existing housing shortage. I do sort of like, I applaud the agencies on their LMI refinance programs. So Refinance Possible and Refinance Now, I think they're called. But even then, that is for LMI borrowers who already have an enterprise loan. So, and in targeted census tracts. It's important work. I'm glad they're doing it. Many lenders like us had already been adopting programs like that. I've had a conversation with, I won't name it at this point because it's not public, but with one of the housing agencies in the markets we serve about that housing agency doing very similar kinds of things. So there's a lot of work to be done. Again, we're at a loggerheads, and it's going to take, in my judgment, all of us individually as organizations to figure out ways to serve those communities, because there's a real pent up need there. So.
Great point, Stan, on the unintended consequences, FHA, government loan buyers. We've seen the percentages decrease over the course of the last 4, 5, 6 months in TMC benchmark, the data benchmarking tool that we offer to our members on government loans, new apps, 22, 21, 20%. I think last month it hit an all-time low that we've seen at 17%. And think about it, if you're selling a house and you've got many offers. I mean, I know, again, I just bought a house and I made sure to bring in my pre-approval letter, like, hey, I'm 20% down. I'm approved for more than this house is. Obviously, if you're selling a huge investment, that's going to be important to you. And that's a great point.
Yeah.
Well, maybe, so challenges for people that want to buy step-up homes, challenges for low to moderate income buyers. Good segue to some other news that came out over the course of the last week. And that was the Biden administration, a proposal that they put forth to offer a tax credit for people that for low to moderate income homeowners that want to rehab their homes. Just reading through and this is just a proposal that was sent to Congress for review. It's not a bill yet, but seems to fit the kind of MO of what the Biden administration wants to do on housing. My initial blush looking at it, that it seems like a great thing, but it seems a little complex. There's a lot of moving parts. It seems like one of those things that could be like a great idea on paper, but difficult to execute. Would love to know your thoughts on the Biden rehab tax credit proposal.
Yeah, I agree with your assessment, Rich. I think normal building challenges aside, because many of those problems we mentioned in new construction certainly exist in rehab, I do think that's a likely outcome for consumers. They can't buy existing house, they can't build, so the heck with it. I'll just rehab where I'm at now and make it more livable, make it meet my family's needs. But I agree with you. I applaud the effort in the tax credit. I do think it's going to become wildly complicated when you start to consider the necessity of making sure you have quality workmanship, quality builders, contractors working in distressed neighborhoods, in urban redevelopment environments. I sit on the board of Habitat Pittsburgh, and they do phenomenal work, urban redevelopment work, but resources are limited. So it's one house at a time, one block at a time, maybe two houses at a time, because there's a lot that goes in to making sure that that homeowner, who already has economic challenges in many cases, ends up with the kind of product you want. So I think it's going to be wildly complicated to make something like this work, but I applaud the effort. I'd rather see them make an effort than not. And then I do think if we continue to have good dialogue between the lenders and the government agencies that administer this, I think over time we can smooth out some of the kinks and make it work. I really appreciate the effort. I think it's a constructive effort. I guess I have a wait and see kind of disposition towards it right now.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by First Commonwealth Banks, EVP Mortgage Banking, Stan Foraker. We got about 7-8 minutes left with Stan and some miscellaneous stuff that I'd love to hit on here, Stan, to close things out. The just LO comp and recruiting climate right now. Last year was obviously a weird year. It was, obviously the uncertainty related to the pandemic, and then just this onslaught of business. Not a lot of movement of any employees outside of ops employees that were paid like movie stars in some cases. But the recruiting climate on LOs, as it started to open up, I mean, the way I view it really just, we have IMB members, we have bank members. I feel like as we move forward, the banks are at an advantage from the standpoint that construction, jumbo, and a lot of these products that will represent a bigger piece of the pie than they have in the past. Much easier for the depositories to do that. At the same time, the IMBs, after a year like last year, record volume, record profit margins, more likely to open the wallet and go on a spending spree. How would you assess the recruiting climate right now in our industry?
Yeah, I think it has started to open up a little bit, just because wallets and pipelines have moderated a little bit. Everybody's wallets aren't fat right now, so that does open the door. And if individuals have felt like they've missed something in their product line or their support, it is starting to open up a little bit, moderate a little bit. And I do think, Rich, that lenders, whether you're an IMB or you're a credit union or you're a depositor, a bank depository, I think that this is a theory that I can't prove, but your listeners can't disprove. I think lenders are like people, that each one has their own personality. And so when it comes to recruiting, it's long ago it went out the door that we'd sit down with somebody and say, how much business you want to do? Here's how we'll support you. Let's talk about the conversion, right? Now it's a matter of culture. It's a matter of execution. What's important in your business, the nature of the product that lender wants to develop and run with, whether that fits your business model. So you've got to start from a recruiting standpoint more than ever before. You got to fit the personality of the business of the LO to the personality of the lender, I think. And again, some people may disagree with me. So I think that makes it a more constructive challenge, but a bigger challenge trying to fit the right people to the right situation. I think 20 years ago, it might not have been as complex, but I think that's kind of what's going on. And you mentioned LO comp. I mean, I think I've said to you before, no lender, no leader is worth their salt if they're not always thinking about LO comp, right? I mean, I read, I think it was in Housing Wire, talking about different options on how to handle LO comp. It's a constant conversation. Every one of your conferences, we talk about it. We're all still trying to figure out how to best support our superstar lenders and the markets and continue to manage margins, because thin margins are a problem for everybody in this market where production's starting to decline a little bit.
Return to the office. Just in talking, our members are all over the board on this. Some want to get everybody back. Some don't want anybody back. The majority want some kind of hybrid. Where's First Commonwealth Bank's mortgage division at with return to the office?
Yeah, with the exception of maybe half a dozen of us, nobody's coming back to the office. We were pretty much there anyhow before COVID, so we were fortunate that we were mobile. But I just cut my my number one operations center physical space in half, and that's just to accommodate the half dozen or so that are going to continue to come into the office. So we're going to continue to go down this path. We like in-person meetings again, but not a lot. And but we expect to have people work from home. We did a lot of work with our employees, and I think it's been 95% of them said, yes, I don't want to fight traffic. Yes, I'm saving money by staying home. Yes, I'm more efficient because I can get up in the morning, work, start working at 6:30 or 7 in the morning. If I need to stop and go water the flowers or take the dog for a walk, I can. And that really has contributed to their quality of life. So we're pleased with the outcomes. I think like a lot of folks in your audience, efficiencies have improved. We've seen that dramatically. So we're going to continue to go down that path.
Emerging technology, a perpetual top topic of conversation in our industry now for years. Last year, I think at the beginning of 2020, almost every one of our members, would have listed assessing our systems and implementing new tech and platforms as a top priority. March hits, they cancel March Madness, the world goes into a tailspin, volume picks up. Nobody has time to, or very difficult to assess new tech and implement new tech options. So really has been a top of mind issue for our members to start this year as we get into the middle of it. Same tale for you guys at First Commonwealth. How do you just view emerging tech in the industry as we sit here in June of 2021?
Yeah, I think I read again, I think it was in Housing Wire, an article talking, there was a couple of sentences that stuck with me, and that was that I think it said millennials were first with digital, or were digital first, but Gen Z is mobile first. And I thought, well, what's the difference? And then it dawned on me. We've already moved past where we say to that consumer, go home and get on your home computer and apply for a mortgage. It'll be really easy when you do that. We've got to go from there to, hey, while you're in the line at the grocery store, you can apply for a mortgage. That's what we've got to get to. That's what Gen Z demands. So we at First Commonwealth are very cognizant of that. One of the things I've always liked, and I'm conscious of the time, Rich, I know we're out of time, but one of the things I always appreciate about my IMB brethren is I always thought they were more nimble in this space, and banks have been a little stodgy and slow to act. We've tried to not be that. So we're very sensitive to that. We're putting in digital, but we are putting it in a piece at a time, not 5 pieces at a time. So we are very much attacking the mobile-centric, mobile-first outcomes when it comes to that. E-closings, all the things, that we talk about a lot at the conferences. So.
How is it June of 2021 and e-closings are not rampant in our industry yet? It's through no fault of me or you or anybody in the industry. It's laws and other stupidity. It's insane to me that, I remember having conversations like this 4 years ago, like, 2018 will be the year at all, crazy.
But once I get mobile delivery done, then next thing for me is I'm going to look hard at e-close, because we just have, that's what I mean. We're putting our tech stack together one piece at a time. I applaud those who are doing it 3 at a time.
Wrapping up here on the last week in mortgage today with Stan Foraker, First Commonwealth Bank. Any predictions? Anything you got for us for 2021?
I think when that tsunami from existing to construction back to rehab starts to really slow, I do think there'll be a little more action in refinance because of the rehab activity. I think that's probably where the second half of this year, at least the last quarter, first quarter of next year, ends up a little more refinance than we thought. And then I do think the Cleveland Indians finish a solid second in the American League Central. Those are my two predictions.
Second is fine as long as they get the wild card. So
That's right. Wild card matters, right?
a lot of competition in the AL East. So, do need to cheer for losses, injuries, Rays, Red Sox, Blue Jays, Yankees. And because the Indians have it pieced together right now with popsicle sticks and rubber bands in the starting rotation.
Yes, they do. Yes, they do. Yep.
Excellent. Well, Stan, thank you very much for joining me. As always, great to see you, and appreciate your membership and taking a chance on TMC early, and your leadership and guidance and the impact you've had on my career. I really greatly appreciate it.
Thanks, Rich. All the best.
And to our viewers, thank you for taking out 30 minutes of your time. We're here every Tuesday at 2 p.m. Eastern for the Last Week in Mortgage Today. Of course, we also upload this to our podcast channel and release this on our YouTube page. I know a lot of people listen or view it there after the fact as well. So until next Tuesday at 2 p.m. Eastern, have a great week, everyone. Take care.